just wanted to thank Taxmann for taking this kind of initiative and giving us a platform. And it's a wonderful initiative. And in my experience in the last 15 years, there are at least 1,000+ people who would have asked me on how the benchmarking analysis is done and what basis the filters have been determined. So this question keeps on coming to me on a day-by-day basis as well. So from an overall perspective, we will start the session with the basics or the fundamental concepts which will help you understand the benchmarking process as such. But from a specific databases as such, we will cover it in the last half an hour. But the first 20 minutes and the next 10 minutes, we've planned in such a way that we cover the basics also, so that people who are listening to transfer pricing for the first time, since this being a first webinar on transfer pricing, we just thought that the background also needs to be given. And we have given all the step-by-step analysis in the last 30-40 minutes. So let's go to the basics first and cover the relevant aspects of benchmarking, both in India regulations as well as UAE regulations. The entire presentation has been designed in such a way that it is useful for both India and UAE jurisdictions together. So we will start with how the concept of transfer pricing has evolved and why this concept. Mostly all the tax professionals would be knowing the fact that these aspects of transfer pricing have evoluted on provisions of OECD and the global regulations, where they want to ensure that the related party transactions are at arm's length. So any kind of anti-abusive provisions or profit shifting regulations or enhancing the transfer pricing compliances as such, on par with the latest OECD BEPS report as well. There are regulations which keep on coming to arrive at these kind of objectives. So on your screen, there are 5 to 6 objectives where we are incorporating the transfer pricing regulations on a day-by-day basis. In 2001, the Indian government has introduced the transfer pricing, if you talk about the evolution of transfer pricing in India. But if you specifically take the entire jurisdiction as such from an India perspective is concerned, 2012 would be the landmark year where a lot of changes and the global evolution of transfer pricing regulations has happened in India. And it was a time where the retrospective amendments, the international transaction amendment definitions, and also the alternate dispute resolution mechanisms were introduced into the Indian jurisdiction. Now, from an overall perspective, India as such, from a jurisdictional perspective, is recognized to be an aggressive jurisdiction from transfer pricing. The tax authorities have been imputing huge transfer pricing adjustments. And the reason for that would be that the concept of transfer pricing implying the fact that whether your related party transaction is at arm's length or not, when they determine the transfer price and when they determine the arm's length price, the arm's length price is subjective, and it is regulated exercise among the transfer pricing authorities, where they kind of do a industry-wide analysis. So on what databases do they do this arm's length evaluation is a basic fact or the fundamental drive of this entire session. So there are no specified regulations which identify the transfer pricing databases as such. There are only regulations pertaining to arm's length price or determining the methods and the most appropriate method, which you are going to see in the next 10-15 minutes. But there is nothing specific to selection of the TP database as such. So from evolution of transfer pricing till what the tax authorities have been doing will be the overall concept from this session. In UAE as well, in 2023 June, they have introduced the transfer pricing regulations, and they have come out from evolution of 2017, where the VAT and other laws were introduced, and CBCR being introduced in 2019. June 2023 was the major shift in the UAE jurisdiction, where they have adopted the transfer pricing regulations along with the corporate tax. There are certain differences between UAE and India, which I will cover in the later part after specifying the databases arm's length perspective. But overall, the concept and the intention and the objectives are the same. From associated enterprise perspective, this is the definition. So identifying the associated enterprise from ownership, management, control, capital, direct and indirect relationship, and having certain quantified filters in the income tax regulation would help us identify the related party transactions. In UAE, it's more than 50%. In India, it might be 26%, it might be 51% of the loan, it might be 10% of the guarantee. So there are specific aspects of ownership, management, control, capital, wherein directly or indirectly, even if you're holding more than 26%, it falls into the deemed associated enterprise definition. So from a overall perspective, what kind of transactions do we deal in terms of identifying the benchmark? How do we evolve over the transfer pricing regulations? And what kind of industries do we see as consultants or as professionals is summarized in this table in terms of dealing with tangible property, intangible property, financing, servicing, and business restructuring transactions. These are the specified international transactions which the tested partner, I mean, the entity where we are doing the benchmarking analysis is dealing with its related party. So the entity which we are dealing with is generally called as a transfer pricing tested party. So that is an altogether different concept. But the point that I'm trying to tell you in this slide is the volume of variations in which the transactions can happen between the related parties. So service, it might be product, it might be an asset, intangible property, and business restructuring. For specific set of activities, there are specific set of methods which we use as most appropriate methods. So wherever there are trading transactions, mostly it is RPM. Wherever there are specified manufacturing transactions or a contract manufacturing kind of a situation, we are going for CPM. And wherever the product and service is, transacted between each other in terms of identifying the net margins, and there is broad comparability and industry margins being available, then we would go for TNMM. So CUP is the most preferred or the most widely used method, but it requires strict comparability, and hence CUP generally doesn't have validity in the context of the today's session, because it is internal comparable or an external comparable where you are specifying on strict comparability. It should be apple to apple. So there is no specific wide variety of arm's length or a comparable average that we take in terms of a CUP transaction. So from a royalty range and also from an intangibles perspective, mostly PSM or the profit split method is the most important scheme of things. In terms of regulated activity, where the transactions between the related parties are intrinsically linked, then there is specific requirement of profit split method coming into picture. So the types of transactions and the methods, and from where we get these arm's length considerations, the third row is the most important row for the analysis. From where are we getting? If you determine the transaction, you identify the related party, you identify which is the most appropriate method for you. From the most appropriate method perspective, which database are we going to use is the most important thing. This is not specified anywhere. Generally, in India, there are three databases: Prowess, Kaplan, and ACE. And in UAE, widely being used at the moment is TP Catalyst and S&P Capital IQ. So in perspective of product and service, widely used databases are Prowess, Kaplan, and ACE in India. But in terms of intangible, in terms of royalty, we are going for a royalty stat regulated database, or specific to specifying the royalty rates as such. We're going to see Prowess, royalty range, loan connector, and TP Catalyst today. These are the four databases which we have covered in this today's session, so that we have a flavor of international database, we have a flavor of domestic most widely used database, we have a flavor of intangible transaction benchmarking. We also have a transaction where loan benchmarking is shown. So the structure and the objective with which we are doing this, the coverage of the overall perspective is what I was trying to summarize. Now, arm's length price generally in India the most litigated aspect in terms of arriving at the arm's length is what we are trying to cover. But in terms of identifying what is arm's length, there have been shifts and shifts by leaps and bounds, where the 92C2 regulation has been changed 3 to 4 times. They have said earlier, where single year data was used, that the regulation was plus or minus 3%. The earlier provision I'm talking about, 92C2. But after multiple year data coming into picture, 83/2015 is the notification number, where they have allowed you to use multiple year data. The provisions have been enhanced in such a way that 35 percentile to 65 percentile is being used as the arm's length indicator, as a range, as an arm's length range. So after identifying the prescribed methods, after selecting the last set of the final set of comparables, what is the arm's length range and where do we identify the arm's length range, or the sweet spot of the industry, is what we would be looking at in 92C2 perspective. If it is more than 6 comparables, we're going to use the 35 to 65 percentile. If it is less than 6 comparables, it is going to be plus or minus 3 for any other cases, and plus or minus 1% for wholesale traders itself. So these are the methods that I was talking about: CUP, RPM, cost plus, transactional net margin method, and PSM. There is a 6th method, which is called as a residuary method, or other method, Rule 10AB, which specifies the transactions ought to have been happening. So there is a difference between CUP and other method, where other method specifically recognizes transactions which ought to have happened, and there is a market indication of the transaction that if at all it happens, in terms of quotations, market valuations, and rate cards, is what generally we use to arrive at a conclusion that what's the market indicator. So from applicability of different methods in different types of transactions is what we are trying to summarize in this slide. So wherever there is a specific indicator, if you see, the most widely used method is TNMM. And this TNMM requires arm's length consideration, or a range indicator, from the overall database perspective. So from where do you get the net margins? From where do you get the comparable arm's length range is the most important factor in TNMM. So from TNMM perspective, how do you measure the profitability? The most widely used phrase in terms of the arm's length considerations have been the comparing business performance metrics with independent industry best practices and the performance indicators of profitability at net level. Now, wherever the economic analysis is happening, the price set, the transfer pricing between the related party, is compared with the third party arm's length price. So this economic analysis and the performance metrics indicators will be the benchmarking process. So whenever you are comparing any performance indicators or the metrics as such, the ratio that would be required to measure the profitability is called as a profit level indicator. So this profit level indicator would be the ratio or the formula to determine the transfer price and the arm's length range also. So RPM and CPM are the gross profit level indicators. CPM is used for contract manufacturing kind of a scenario, where there is both related party manufacturing, third party manufacturing, and there are gross margins or on the direct and indirect costs of production is available. And we compare the gross margins of related party and third party. From a TNMM perspective, mostly there are net margin ratios which will be used. From overall, scenario, if you see, there are different bases for which we use a certain kind of ratios: Berry ratio, cash PLI, and net margin related ratios. So from PLI perspective, if you are computing the profit level indicators, what are to be considered as operating and what are to be considered as non-operating are the most important criteria. Anything that is pertaining to business operational cash flows, which is affected by the business, scenarios or the actual operations, is called as operating items, and non-operating items are something notional which does not outbound from a business regulated environment, is called as non-operating items. The most widely elimination or the conflicting situation would come in finance charges as well as the forex. So these are the two important things. From an operating item and non-operating item, how do we calculate the PLIs? From a range concept perspective, this is what I was trying to say, where the multiple year data is being used. From an international perspective and also from the regulated perspective, most important thing from the recent amendments as such is this 35th percentile to 65th percentile as such, where the range is arrived at where more than 6 comparables are there. If it is less than 6 comparables, it is going to fall back to the tolerance range of plus or minus 3% and plus or minus 1%. In 2014-15, they have arrived at a conclusion that multiple year data is going to be used. What is called as multiple year data? The year for which we are doing the benchmarking and the previous 2 years will be captured. The financial information will be captured of the comparables, and they are going to do a weighted average of these profit level indicators and arrive at ascending order of the performance indicators, the PLIs, and then the 35th percentile to 65th percentile data is going to be used per se. So from overall profitability perspective, most important things that would be required to be analyzed in today's session will be the economic analysis perspective. In this economic analysis, most of you would be knowing the 3-tier documentation zone, where we are specifically reporting to the governments in Indian government, especially in 92D. There are local file, master file, and the CBCR requirements per se, of course, and each of them have their own thresholds. Wherever there is international transaction more than 1 crore, the local file TP documentation and rule 92D and the section 92D and rule 10D are the specified regulations, and there are 13 different clauses under which we are required to maintain this TP documentation. Master file is applicable in a scenario where more than 50 crores of international transactions with the group is there, and there are specific indicators or requirements from a group profiling perspective. The most important thing, why am I showing about the documentation, is the fact that benchmarking and TP documentation are two different and important concepts as such. Local file is the document which is part of the compliance, which has to be maintained as on the date where you are filing the form 3CEB, which is the reporting audit for transfer pricing audit document that we are filing in the income tax filings at the end of the year. Master file and CBCR are applicable for very huge entities or global MNEs, where the requirement is very high, with 750 million euros for the CBCR and 50 crore and above for the master file as such. So from a economic analysis perspective and identifying the transfer pricing databases and using the transfer pricing data perspective, economic analysis of comparing the related party and third party transactions would arise in 2 scenarios. One is local file, and the other part would be on identifying any benchmarking report that we do regularly for new or identifying the industry averages wherever the global MNEs would try to assess the margins to be maintained in India. So economic analysis will be part of TP documentation or the benchmarking report as such. So this is the overview of the benchmarking analysis that would be done. So the transactional analysis are the basic facts, which service activity, the transaction flow, the entities involved, the segments, remuneration mechanisms, and the existing price or margin. These are the facts. The functional analysis per se, this would determine who is performing which type of functions and who is performing or who is adopting which kind of risk. If the risk is more, reward should be more. If the risk is less, reward should be less. If the functions performed are more, then the reward should be more. If functions performed are less, then the reward will be less. So the FAR analysis with the supply chain perspective would determine the shift in the reward and risk perspective, and the entire supply chain needs to be evaluated before benchmarking any of these transactions. From full-fledged contract manufacturers and and a limited risk manufacturing perspective or a limited risk distributor perspective also per se, from a characterization, limited risk indicators or the limited risk entities would determine a fixed margin or a standard remuneration methodology versus a highly entrepreneurial kind of an activity where it is doing more of a business oriented and self decision making kind of entities. So the reward for entrepreneurial activity will be more, whereas the limited risk distributors or limited risk manufacturing entities would be less. It would be standard, it would be fixed. So the risk is less, so the reward will be less. So the economic analysis, the conclusive judgment, the conclusion would be arrived in the economic analysis section, where what all we discussed till now is going to be, coming into picture. The transfer pricing method, the tested party, and the profit level indicator. Whichever entity is the least risk mitigated entity is normally selected as a tested party. In India, normally most of us have been, looking at the Prowess Kaplan A's, and the tested parties are normally selected as the Indian entities. But of late, the trend has changed. The limited risk identification has been given much more importance, and even the tax authorities started using foreign entities as tested parties. So earlier, the access to the foreign databases was not there, and there was huge negativity on the foreign tested party selection. But now they got access even to the foreign databases, and identifying and selecting the foreign entities as tested parties has begun even at the tax authorities range. So from economic analysis perspective, we have identified the method, we have identified the tested party, we know which PLI and ratio to be adopted. Now, from a selection of TP database perspective, comparability analysis, arm's length range, the TP database would be dealt with in the next half an hour or so. I'll just conclude on why benchmarking and what's the intent behind this, and then go to the preferred databases, which would suffice on the background. Now, the benchmarking per se, in the overall perspective, wherever we are identifying internal data and external data, the most important thing that would be given as a priority would be the internal comparable data, because that is fact specific and that is immediately identifiable, and it can be compared on a real-time basis, provided both of them have similar characteristics, performance, date, criteria, and size and material. But the point that we have to always keep in mind is, if there is an internal comparable available, the preference should be given to internal comparable, and that has to be documented. And if at all you feel that it is not comparable also, we need to specify the reasons and compare our product and say that you cannot compare the internal comparable. There have been certain situations where the internal comparables have been identified, and they were having much more better profit margins than the related party transactions. In those scenarios, it is very important to specify why they are driving these kind of better profit margins in terms of their risk capabilities. The data sources per se, if you see, these databases have certain limitations on the publicly available information. Even these companies, CMIE per se, from Prowess, and also from TP Catalyst perspective, Bloomberg, or the royalty stat databases, they have certain limitations in capturing the data and publishing them error-free. So the point that I'm trying to tell you is, in terms of jurisdictions, in terms of availability of data, in terms of timing differences, in terms of the financial year differences, there are a lot of limitations with which we have to segregate and identify the actual comparables out of the industry. So the TP databases, we would be looking at Prowess, we'll be looking at royalty stat and loan connector. So these databases right now are the most prevalent and most widely used databases. In paragraph 3.4.3 of the OECD guidelines, there are certain regulated aspects on the quantitative and qualitative filters per se. See, in terms of the practice as such, these quantitative and qualitative filters are part of the chapter 3 of the OECD guidelines on the comparability analysis, where the filters or the criteria with which we adopt the comparables is specified. So the comparability analysis chapter 3, para 3.4.3, has criteria in terms of the size, intangibles, availability, whether you are doing R&D, whether you are having a NAV on that particular entity, are you doing any kind of R&D activity which is giving you significant value in terms of intangible, are specified as criteria. But the other quantifying factors have been specified with respect to export related in terms of the related party transactions percentage, in terms of excluding the third parties in special situations as startup and bankrupt. So these are the adjustments which would enable the level playing field identification. So in para 3.4.3, they have identified certain filters in the way in which you can identify the relevant comparables, starting from size, starting from R&D activity, IP, criteria of exports of foreign sales, and also the relevant value where the inventories is obsolete. And the other parts on the general criteria are the adjustments. If at all there are any special circumstances, how the adjustments needs to be calculated, also specified in the Indian regulations as well as the OECD regulations, where capacity utilization, working capital, risk adjustments are being deployed to bring the arm's length nature or transfer price in the related parties to one place. This is para 3.4.3 of the OECD guideline. In terms of the UN, there is a specific chapter. Again, this is chapter 2, part B, which specifically talks about the comparability analysis, almost the same language. Will not waste much time on this, but the overall thing that I'm trying to tell you is on the OECD aspect of transfer pricing and UN aspect of transfer pricing, which specifically talk about comparability analysis and how do we identify, how do we land the comparables out of the database, and what kind of filters from a qualitative and quantitative aspects are concerned. These are global regulations from which we adopted. Indian TP regulations do not have any guidance on applicability of these filters and how the search process needs to be determined. There are certain, judicial precedents which have specified the criterias and, the basis which were relied on the OECD guidelines. That's how there has been a standardization in the way in which we do the transfer pricing benchmarking from these databases. So from a stepwise perspective, this is the most important slide. From overall identification of the method till the economic analysis adjustments, what all we have covered till now as a background is what we have captured here. So all the concepts, all the 9 concepts is what we have captured. We have to do only these final set of comparables, and the 5, 6, and 8, 5, 6, 7, and 8 are the left out things from a benchmarking aspect is concerned. So industry classifications, how do we identify the industry specific service product? How do we do the qualitative analysis in terms of measuring the relevant comparability in terms of identifying the specifics out of the annual report? From final set of comparables, whether you are going to do a 3-year average, multiple year data, 35th to 65th percentile, whether you are falling within the arm's length or not, would be the final set of comparables. The quantitative analysis is something that I just showed on OECD, where the data should be available, the range and the size of the entity should be minimum of 1 crore. The positive net worth is one of the criteria to be taken into consideration, whether they are doing a core activity. If they are doing more than 1 or 2 activities, the activity for which we have selected that company as a comparable should be more than 75%. So the export earnings per se are considered to be, whenever we are an export oriented entity, the export earnings in the comparable company should be more than 75%. The related party transaction should not exceed more than 25%. So there has to be an independent nature of any comparable company. There has to be an identified factor where you are recognizing the company to be an independent company. There cannot be more than 25% of the related party transactions. And thus the quantitative analysis in terms of all these filters would help you identify and eliminate the uncomparable companies and arrive at a final set of comparables. So these quantifying factors in terms of more than 1 crore, more than 75%, and more than less than 25% have not been defined anywhere, but they have been standardized over a period of time from the regulations and the judicial precedents as such. And these have been standardized over a period of time. So unfortunately, even the UAE regulations also have not given any specific filter or quantifying or qualifying filter, but they have given detailed guidance on all these aspects and concepts per se from an economic analysis standpoint is concerned, and they have done a very nice job on the guidance note as such. So coming to the databases. So the overall perspective in the databases would be the manufacturing and the interest transactions and the royalty transactions. So we have categorized three sets of transactions. One is a product and service. Other thing is interest and loan transaction. And the third part is royalty on the intangible assets. If you look at this, there are specific aspects where we have identified the databases on the basis of the transaction, and we have also given a bifurcation on the region for which this particular database is useful, and also we have given where all the global requirements or the global data is available. So from an overall perspective, these 8 or 9 databases are the most important transfer pricing databases that are widely being used for any kind of transfer pricing benchmarking analysis across the world. So this language that we are talking here from a transfer pricing benchmarking perspective is a global language. And even sitting here in India, we are doing global benchmarking studies for almost 150 plus companies with these 9 databases access. So and also the process in which we are establishing these factors of identifying the comparables in each of these databases is widely common. So there is a process in which it goes in terms of the quantifying filters. These, if you understand that process, it is going to be a 20 minutes job. If you don't understand the process or the formulas in which they are using, then there will be a confusion. That is why I spend more time on the concepts than putting those concepts into the database is just clicking of the button. Now, in these transactions, we have identified Prowess, and we have done loan connector for interest, and we have done a royalty stat and TP catalyst for the global. So we are going to see the 4 benchmarkings per se. Qualitative and quantitative analysis is what we are looking at. In terms of the qualitative filters, the source of the qualitative filters will be the annual reports, public domain information, and the management aspects. These normally are available in Capline or the MCA data or the AS equity data, where we can extract the annual reports and study the various aspects of qualitative filters which are there on the screen. Products and service profile, is it relevant for you? Is it the criteria with which we are identifying that company as a final set of comparables? Segments in which it operates, presence of IP, R&D function, the fluctuation of abnormal profits versus standard operations, any extraordinary circumstances that have happened during the year and the profitability shot up. This is one of the important things where the entire set would be disturbed. Earlier in the 92C2 regulation, wherever there was an abnormal event or a profitability, the entire average was disturbed by this particular extraordinary events. Even now, wherever there are extraordinary events like amalgamations, merger, restructuring, and situations like COVID or earthquake or the company being facing any kind of earthquake or a fire incident, these aspects would have a significant impact. So eliminating them and identifying them would be the most important factor from a qualitative perspective. Government companies, we generally avoid to take in terms of the regulated set of final set of comparables. Exceptional year of operations needs to be avoided to get a flare of an actual range of the industry. So mostly we avoid exceptional year of operations, we avoid extraordinary circumstances, and we do a qualitative check of these 8 parameters from the database as such. So from a quantitative analysis perspective, there are certain general filters and there are certain specific filters which we work on. Availability of financial data, different financial year ending, turnover filter, net worth filter, consistent operating loss, and also the employee cost filter and related party transaction filter. These are the 8 filters that we generally apply to arrive at a final set of comparables from a service and product perspective. Employee cost filter is specific to the services, but rest of them from an export-oriented international transaction benchmarking perspective, these 8 filters would be the process in which we are eliminating the comparables. So I've specified certain quantifying factors like sales being more than 1 crore, financial year should be the same. If at all financial year is different, then the adjustments of 12 months in terms of the 9-month and 3-month period for March and December year ending has to be quantified from the annual reports and has to be documented as part of the TP documentations. So wherever there is more than 1 crore, wherever there is a net worth positive, wherever there is a loss making continuous for 2 years or 3 years, wherever the exports are more than 75%, the employee cost filter being a service oriented entity, your employee cost should be more than 50 or 75% of the total operating cost. Related party should be less than 25%. So these quantitative filters will be applied in the database to arrive at a final set of comparables. So these specific filters are something like I just mentioned, where employee cost filter is applicable for service companies, and the manufacturing income filter would be applicable specifically to the manufacturing sector, where the core activity or the product analysis is coming into picture. So now coming to the databases per se, the way in which the steps of the comparable analysis is being documented in terms of identifying and shortlisting the comparable companies is what we are looking at. So if you summarize the overall steps, these are the 6 different steps in which the comparable companies would be identified. First, the industry or selection of comparable companies for the specific service or the product, identifying the company address and the indicative aspects of operations on the current output sheet. Wherever there is OSC, that is referred to as output sheet. Identifying financial information to the companies and adding that to the relevant set of companies in the same industry. We give a financial year indicator. We kind of select the currency. We select the overall information that we want in terms of turnovers and operating costs to arrive at the profitability. So all the financial information will be added. You will see that on the screens specific to the relevant databases. I'm just summarizing what all we do as steps for the quantifying filters and quality aspects, where we arrive at the final set of comparables. So after doing the first 4 parameters, you kind of get an accept reject matrix where the total comparable companies in the industry will be boiling down to an X number of comparables. The qualitative aspects on the annual report on specifics that I just mentioned will be tested, and then the business descriptions will be documented and the final set of comparables would be arrived. So coming to the steps, all the steps we have taken from the database as such, in terms of having the screenshots are readily available. We could not run the entire database as such because of the timing restrictions, but the specific aspects on a step-by-step basis as a guide is put in this presentation also. This will be shared online and it can be taken from the Taxmann portals. But these steps, if you follow from each of these aspects, first step would be to identify the product and service per se. In terms of business segments and products, there will be a login ID and user ID and password, which is the general step. However, from a selection of the Prowess database as such, the first identifying filter or the step would be to identify the main product or the service. In this main product or the service, then they go and select a specific product or the service within that particular category, which you are going to identify, or the broad range of industry in which you are in which you need the comparable companies. Then the data on which the date and the currencies would be done, and all these companies would be sent to a new output sheet. So once we select the industry, once we select the specific products and service, all these companies that are falling into that particular industry would be sent to an output sheet and added as a base or a master data of the comparable companies in that particular industry or a service or a product. Now, after you send it to an output sheet, this particular new output base where the data would be stored will be blinking all the time. Wherever after it generates any report, after it applies any filter, this particular new output sheet would be blinking, and you can press continue and move on and keep adding the filters to the master records. So the sequence in which the quantitative filters would be applied is what we are looking at. We looked at the theory, looking at the practical application of these quantitative and qualitative filters. Now, whenever we go to the output view, whatever you just said that, the new output is these set of companies. There are only 52 companies with which we have identified the specific criteria, search criteria in this example. Now, these identifying factors would be further drilled down into NIC activity, the main product service, or the specific indicators, where identifying indicators such as clubbing them into the right activity zone. So even if they are having a mineral industry or a specific case, complex situation in a live case scenario for us has been that for a ceramic industry company, they've continuously been selecting the trading of ceramic products. So they didn't go into the NIC activity, which was the input of the ceramic industry. So the minerals were the input for the ceramic benchmarking industry as such. But the transfer pricing authorities have been selecting the ceramic trading companies of a different NIC activity. So identifying the specific industry group and the NIC activity and code would be the major thing as a master data. Whatever you are quantifying filters would be applied on would be the specific things. So at each and every stage, all the applications of filters would be added to the current OSC, and they would be stored in the output sheet on a step-by-step basis on a regular at each stage. They will be added to the output sheet is what we would be doing. Now, from a currency perspective, the most important thing is we generally go for the million or the crore, but this has to be consistent and it has to be applied, and the digits and the way in which the data is being presented is very important, because mostly they go by crores, even in at the transfer pricing authorities or the TP office calculations. So it has to be consistent for both tested party as well as the comparable companies. The 3 years weighted average calculations, everything should be in a single uniform contract as such. Now, from a financial analysis standpoint, this is the most important thing, where they arrive and capture the information for these companies that we have shortlisted based on the industry service and NIC activity and the relevant periods. Now, these 14 aspects would be the specifics which we draw from the query tab of the Prowess database, where we kind of select the annual financial statements, which is the main tab. We go and select the annual financial statements, under which you can select the specific criteria of the detailed P&L and balance sheet items, which are generally characterized. So under this, there have been a few instances where the categorization or the heads have changed, but from a accuracy standpoint, 90 to 95% they have been correctly placed, but there have been situations where the heads were different and there were a lot of confusions. So whenever we arrive at the final set of comparables, it is advised that we go to the annual report and compute the profit level indicators. This is to identify a specific set where the quantifying and qualifying filters are apparently and blatantly can be rejected. So this process would help you to eliminate a lot of comparables, but not the specific aspects of quantifying and quantifying, which can be done from the annual report per se. So all these 14 aspects we can select and identify and then pull it on to the output sheet again. So these databases on a specific query date from financial year perspective, from OSC perspective, they will be added to each of the output sheet, and then the Excel tab would be saved and it would be derived out of the Prowess database, and it will be used as the annexures for the TP documentation. Related party transactions are generally avoided. So if at all there is more than 25% volume in under this tab of the related party transaction where the ownership structure is there, these transactions needs to be avoided, and the companies which are having more than 25% of the related party transaction volume also needs to be avoided. So from a case study perspective, all these steps, once you arrive and once you specify, we have given a case study also on a step-by-step basis where you can practice and also have a guidance note kind of a thing where we are giving you the real examples, and we have done it, as early as yesterday. I mean, as latest as yesterday. So these, can be evaluated on Prowess database on a live run also. So this main product service, the output sheets, the number of companies that are coming, and the specifics of each filter, we have identified and kept it as a step-by-step process so that you can test and practice on a real case study basis per se. So each of the theoretical concepts, each of the steps that we have, told you on the Prowess database, step by step, how the eliminations, how the calculations have been done, have been illustrated in this case study example. So we move on to the, keywords or the industry aspects. So after you perform all these filters, after you apply all these filters, the companies which are not satisfying these filters would be eliminated. They would be avoided because they are not satisfying these filters. From 2,375 companies, after eliminating each of these filters, we arrived at a 10 set of comparables for which we can call them as a final set of comparable companies. In these final set of comparable companies, we need to document the business descriptions from the public domain or the annual reports disclosure or the management report disclosures. And we also need to document the accept reject matrix per se, which can, give you the right perspective and document your process of identifying the relevant comparables. So this accept reject matrix and business descriptions would both contribute to the quantitative and qualitative filters that we are discussing here. So from an economic analysis standpoint, if you remember the slide that we spoke about in the beginning, economic analysis standpoint would be the process of identifying the relevant set of comparables from both quantitative and qualitative aspects. This is the quantitative aspect and this is the qualitative aspect. So 10 has become 7 after the qualitative aspect. And then the 3-year weighted average is being calculated. And these 3-year weighted average per se is specific to the number of companies that we have selected on quantitative basis only. So these quantitative basis have a weighted average scenario where the 10 comparable companies have been identified. 22-23 data, if at all we have not done on a specific date, then 2023 data, if it is not available for these specific set of comparables, it is NA. And the ascending order in which the comparable companies margins have been determined in a sequence has been provided, and 35th to 65th percentile as per the range notification is identified. In our example or the case study where the markup is 10%, will we fall within the arm's length range or not? Is yes, we fall within the arm's length range. This is how the conclusion is arrived at. If at all you are more than the range and you are a tax paying entity, there is no problem and you are above and beyond the range. For a domestic transfer pricing perspective and also from a free zone and mainland perspective, if the margins are more than the comparable range in a situation where we are trying to take advantage of the tax regulations or the qualified regulations where you are exempted from any profit taxation, then you cannot be more than the arm's length range. It gives an excessive or unreasonable base for the officers, the FTA or the transfer pricing authorities here, that would be subjected to the transfer pricing adjustments. So whenever there is a requirement that you are not falling within the arm's length, in a tax paying situation, you are below the arm's length, the base level of 6.85, and say suppose your margin is 3%. From the 3% perspective, you will be enhanced to 14.52, which is the median range. So the transfer pricing adjustments per se would be subjected from 3% range to 14.52. If you are a domestic transfer pricing, subjected entity, and if you are a qualified free zone entity from UAE regulation perspective, you cannot have margin more than 21.41. Say in a situation you are 25, the difference between 14.52, which is the midpoint, and 25 will be subjected to excessive or unreasonable profit making, and they will propose that as an adjustment or a transfer pricing adjustment. So the range, the midpoint, in a tax paying situation, in a tax holiday situation, how are we going to conclude is what we have summarized in this slide. So from a loan and TP catalyst, we have very limited time, but I will try to cover as much as I can. From the loan perspective, the most important aspects would be on the specifics of the term, in terms of period, in terms of the tenure, in terms of currency in which we have intimated the entity or the lender and borrower jurisdictions. These are the specific aspects where the interest benchmarking would be subjected to test, whether you are at an arm's length interest rate regulated aspect, or you are paying excessive or unreasonable interest. These interest limit benchmarkings have another important objective in terms of thin capitalization regulations or the 94B regulations, where the Indian government has restricted it to 30% of the EBITDA. So wherever there is a specific aspect of interest benchmarking, we need to be specific to the regulated aspect, where the loss-making entity, if it is making any payment of interest, it should not exceed more than 30% of EBITDA. The interest should not exceed more than 30% of EBITDA. The interest per se, the rate at which you are paying the interest, would be determined based on specific aspects of, the issue date. These are the specific criteria on which we run the transfer pricing database. Issue date, the maturity period, the tenure, and the credit rating aspect of the lender, and how the specific jurisdiction is being looked at, the base rate on which we are currently working on in that particular jurisdiction, or now it is CIFOR, earlier it was LIBOR. These aspects, once we take into consideration and apply a specific search criteria, then the TP loan connector database as such would give you the results of the interest benchmarking. Now, these members of the group are the lender and borrower. What you have as a group credit rating is the second step in terms of identifying the credit rating reports. This is how the credit rating reports would be looked at, and it would be ranged from AA to C, the CCC minus, where the prime lending rate will have a better interest rate of charging the specifics of low interest rate, where the credit ratings are much better, and the lowest possible is CCC minus. So the lender and the borrower jurisdictions, the group credit ratings would be subjected to a test, and these credit ratings would need to be imputed into the loan connector database to identify the specifics of the interest rate benchmarking per se, other than the loan tenure and the foreign currency in which we are operating for the interest benchmarking per se. Now, the potential credit rating would be depending on whether you are a core activity, whether you are a strategic level or at an operational level. So these strategic level players would be having the higher credit ratings or better financial stabilities than the lower operational level entities. So categorizing them under different aspects, identifying what is your group credit rating would be the key. So mostly Indian jurisdiction is all on the non-strategic and operational entities, and the lenders have been the specifics of strategic nature. So wherever there is external commercial borrowing into India, mostly the strategic players have been outside and the operational entities have been within India. So these aspects, the step 5 and step 6, are specific to adjustments that would be subjected, where there are sovereign risk at a country level, the poor performance aspects in terms of war, in terms of the global regulations. If there are any restrictions, sanctions, or any kind of global impact on the interest rates, those adjustments needs to be taken into consideration before finalizing any aspect. So the first 5 steps are the most important things, where you are identifying the relevant set of jurisdiction, the lender, borrower, currency, credit ratings, and the specific aspects of application in terms of identifying the comparable companies from a tenure perspective is what we would be doing. So these aspects of the terms of the loan, where we have identified these such criteria, would be run, and there would be a specific accept reject matrix which would be developed based on these aspects when it goes to the loan connector database. So the accept reject matrix and the final set of comparables and the rate at which it would be done, and 35th to 65th percentile, more than 6, all these aspects are common, so I will not be touching them. But the aspect of specific benchmarking of the interest transaction, you need to remember only the aspect of credit rating, which would be the most important topic, other than the jurisdiction, and the base rate, which would be CIFOR from India perspective. Say, suppose if you are 6% in the case study, what would be the specific aspects of the range? So if at all the CIFOR in our example, the floating rate has been arrived at 5.33 to 6.17, it is falling within the arm's length. This is how you would be benchmarking. These 8 companies are the relevant jurisdiction. They are of the same criteria of credit rating. They have been issued for the same tenure, and the rate at which they have been issued the transfer pricing database would throw out the results. You put them in an ascending order, 35th to 65th percentile, 6% falling within the arm's length. This is how the arm's length range from a loan connector database would be arrived at. From an intangible or a royalty, benchmarking perspective, the most important thing would be identifying what kind of intangible property and why you are giving or paying them from a need benefit angle and also from the benchmarking support angle. Other than the industry, for what type of activity are you paying the royalty would be the most important. This is a screenshot from the royalty stat database, where the type of payment or the selecting the agreement per se, what kind of transaction is the most important thing. Here, the industry and the type of activity for which you are doing the benchmarking would be the key criteria. The step number 1, step number 2. When did you start giving that royalty or the intangible evolution, or when did you start making the payment and how did it impact is the license start date at the end. This is step number 3. Step number 4 is to exclude a specific criteria where the intangible property has been given to you on exclusive basis or on inclusive basis. If it is on exclusive basis, the royalty would be charged high because it is specific to that particular person or the particular entity. The related party transaction should be avoided. It cannot be between group entities. The user rights or the specifics of the goodwill nature or the trademark nature have to be specified here again in terms of the rights being granted under that particular agreement. The industry classifications, the geographical scope in which you can expand from a UAE perspective, because the local domain databases are not available in UAE, but from India perspective and from the royalty range perspective, there need not be any challenges. A specific jurisdiction to which the royalty is flowing into or the payer would be the key criteria to evaluate the royalty benchmarking, and the specific filters, the stepwise filters of identifying the jurisdiction, industry, type of benchmarking, the dates on which the royalty has started, and the kind of geographical space into which you have to do the search are the three criteria which we have given. Then it would result into the specific set of comparable agreements summarized for you in terms of inclusions and exclusions. They would throw the results out. This would be downloaded into a specific aspect of Excel or the Microsoft Dynamics page. Then this particular aspect would be reviewed on quantitative and qualitative aspects more thoroughly and arrive at a final set of comparables. So this process is the same. So only thing that would be different is how you would be benchmarking an intangible would be determined based on the type of activity and the type of industry, because each industry, each type of royalty and intangible property would be different, and that there lies the actual challenge. So for you to be more specific and identify the relevant drop down and the categorization would be the most important thing. So from the case study perspective, what we have just run in these 2-3 steps in these 2-3 slides from a 13 to 14 step criteria is concerned, they have got 841 for which they have derived 8 comparable situation from quantifying aspects or the specifics of the relevant royalty agreement dates. Wherever there is qualitative review and it is not directly comparable, or you felt that this is not straightforward comparable, we have eliminated one company and arrived at a final set of comparable agreements, which are 7. So this is how the final set of comparables for a royalty benchmarking would look at. So these are the licensors, this is the licensee, how much royalty rate they have paid, what is the base on which this royalty is being paid, whether it is paying on sales, whether it is paying on overall profitability percentage ratio, or whether it is on basis of number of hits and licenses, would be the base on which your royalty is being calculated. So this aspect is also very important as a criteria for selection of comparable companies. The description is the business description or the way you have paid the royalty would be categorized, and this is how the final set of comparables would be looked at. So if you are arriving at a range here, then the range is 3.5 to 4%. And if you're paying within this, it is fine. If you're paying above and beyond 5%, then the midpoint of this particular range would be the adjustment, trigger point to whatever payment excessive or unreasonable you have made. If you are less than this, or if you are within this arm's length range, then there is no problem. So royalty stat databases, loan connector databases, Prowess is what we have seen. From TP Catalyst angle also, it is the same process in which the quantifying filters are being adopted. We have given the step-by-step guide, and we've also given the case study for each of the database, and we have given the conceptual understanding, in the beginning 20-30 slides. So for each database, the process and the steps and the deriving the final set of comparables and what kind of annexures need to be maintained for TP benchmarking and documentation are specified in this particular session. Now, the most important thing, mostly in terms of the identifying, am I out of time or anything? I can extend it for another 5 to 10 minutes. Taxman team, Puneet, you're there? Hello? So I'll finish it in the next 5 to 10 minutes. So from a related party transactions perspective, you have to consider the operational values in terms of revenues and expenses. It cannot be something where outstanding balances are not to be considered in that 25% operational, related party transactions, calculation. The ratios, whenever you are calculating, you cannot calculate and take into consideration the outstanding balances. From an export filter perspective, they can, for domestic transactions or the SDT transactions, you cannot apply this export filter as such, is what we are trying to highlight. The TP methods, wherever there is a specific applicability, evaluate applicability of all the methods and don't directly jump onto the conclusion. Always derive the most appropriate method, metrics, and then go on to the economic analysis of the detailed search process or the quantifying and qualifying filters. Wherever there is only perspective of identifying the jurisdictions, the tested party, there has to be specifics of the functional analysis and the least risk mitigated entity delivering this particular service or the product would be the most important thing for analysis perspective. So the selection of comparables, the flow in which the comparables needs to be selected, there has to be qualifying and quantifying filters. You cannot directly cherry pick any comparable. If you are directly cherry picking any comparable and if it is available in the public domain, you have to specify the source from which you have taken, and it has to be readily available to the tax authorities also. If you are picking up anything beyond the transfer pricing databases and you are trying to identify this into the final set of comparables, then you have to specifically mention that aspect. And this cherry picking of comparables is a litigative thing, but the Indian regulations of late have been allowing to update the search process during the transfer pricing proceedings. In that process, if something is updated in the transfer pricing database as such, if you have seen in the example, 23 data was not readily available in that particular Excel spreadsheet. But if you do it as on today, then the database would be updated. So you can update the search for the same set of comparables and you can present. And if you want any other new comparable to be added, you have to specify why it was not available at that point of time and why you are adding it now. And the source of that particular additional comparable has to be specified. So from a final, touch point, I just wanted to present the differences or the main highlights of both India regulations and UAE TP regulations per se. So there are, coverage perspective, we have deemed international and domestic transactions in India. Domestic transactions are restricted to the tax holiday jurisdictions from ATI and non-ATI perspective. And international transactions are, all the product, service, and tangible and intangible, and the finance-related transactions and royalty range transactions, intragroup transactions. But these regulations have covered most of the transactions. So there is nothing specifically, abnormal about this. Earlier, we used to have director remuneration as part of the domestic transactions, but that was removed in 2016 or 2017. But UATP regulations still have that, regulation where they have specifically mentioned that any payment to the connected person also needs to be benchmarked and identified whether it is at arm's length or not. This criteria came with the objective that UAE-TP regulations should monitor the payments that are going to the key managerial personnel, owner, manager, director, or the authorized signatory, where the taxation at an individual level, when it is not there, there cannot be an abnormal payment and the profitability can be tweaked after these payments. So they have kept a specific tab for the connected person payments as such. So this is the difference between the coverage perspective. From a TP methods perspective, it is the same. Article 34 and Rule 10AB are talking about the same six methods. ALP computation, there is specific 92C2 regulation and 35 to 65 percentile. There it is 25 to 75 percentile. There is no 1%, 3%, 6 comparables and all this confusion in UAE. They have kept it open. So it is just the 25-75. Here, 92C2 and the range notification, multiple year data would be specific and they are computing it based on the number of comparables. So we have to be very restricted to that particular notification when you are applying anything from a ALP computation standpoint. It is multiple year data in both the jurisdictions. There is no confusion. Comparable selection, normally and generally it is India, but in UAE, because of the lack of the public domain information, they have given an extension or the expansion of geographical jurisdictions from UAE to GCC, Middle East, Asia, Europe, and then the American jurisdictions or the UK jurisdictions also. So they have given you the levy to expand the jurisdiction for the same industry. If you don't have the comparables of UAE, then you can stretch to GCC, MENA, and Africa regions and Europe regions as well. So the jurisdictional expansion has been specified in the transfer pricing guide itself. But India, there is enough database available from MCA and all these databases, so there is no problem. Tested party always should be the least risk mitigated entity. There cannot be second thought about it. But India earlier, mostly it was Indian entities or the regulated entities or the operational cost plus captive entities which were selected as the tested parties. Now, if there is any least risk distributor or least risk manufacturer on the other side, then foreign tested party is also accepted and they have been putting it in the transfer pricing assessments also. There is no confusion from a concept or a practical aspect in UAE regulations because only they have captured the least risk mitigated concept and adopted the global language. So there is no confusion from a UAE perspective. Transfer pricing adjustments talk about secondary adjustments in India and talk about corresponding adjustments on the other side in UAE. What is secondary adjustment is if you have done any voluntary adjustment and if you feel that your transaction is not at arm's length, if the voluntary adjustment is more than 1 crore rupee, then the actual money has to come back to India within a set period of 3 months. So this particular period under which the amount has to come back to India for a specific transaction benchmarking would be the key. So they have kept this tab specifically with an intention to curb any kind of notional adjustments and offerings of tax and avoid the cross-border movement of the foreign reserves. So they have kept a tab that if you are doing any voluntary adjustment or if you are accepting the transfer pricing adjustments of the tax authority, then you have to bring the actual money as income into India and offer that to tax in India. If you don't bring it within that period, 90-day period, then the interest would be subjected and it would be keep multiplying based on the specific penal provisions that are mentioned in the secondary adjustment. From corresponding adjustment perspective, wherever there is adjustment on either of the parties, or a seller and a buyer perspective, the relevant adjustment should be given for tax neutrality perspective. On the other side is the requirement of the corresponding adjustments. They have not specified this aspect on methodology and the process of arriving and the timing difference and how the other regulations would be impacted, such as VAT and IFRS disclosures or the accounting and the balance sheet regulated aspects. But they have specified this from a global standpoint. Generally, DTAs kind of give you the corresponding adjustment from a MAP procedure perspective or the global languages. They've just picked it up. But the procedure in which this corresponding adjustment has to be given on the other side has not been specified yet. So these are the snapshot of the comparative of both India and UAE TP regulations. So thank you so much for the opportunity. I think I exceeded by 10 minutes. Thank you, Taxmann.